In this video, I'll discuss everything you need to know about saving money, and we're starting right now. Hey guys, Elliot here. So savings is a really important topic to talk about. Everyone knows you need to put away a percentage of your income for a rainy day, but what's the best way to do it? How much is enough? And what type of account is the best place to put your money? All good questions, and there are a number of ways you can go about doing this. So let's get into it, and be sure to stick around as later in the video I will list out the highest paying savings accounts currently available. Now the place to start is to ask, why do you need to bank a portion of your income? Conventional wisdom usually says to just invest, not save, especially when you're younger and can take on more risk. The answer is that investing and saving is not the same thing. Savings preserves your money, and savings accounts need to be as safe as possible with little to no chance of loss. Investing, on the other hand, grows your money, and this means more risk, including the chance that you may lose it all. And those are the distinct differences between saving and investing. They serve different purposes, and you really need to do both at the same time. As to the original question, why save in the first place, the answer is very simple. You need to set aside money to pay for emergency expenditures such as unexpected house or car repair, or to sustain you in case of a job loss, so you don't end up using expensive credit to pay your bills. It also prevents you from dipping into your investments and missing out on future gains because you had to sell them when you needed the cash. Finally, having savings allows you to take advantage of buying opportunities when investments are attractively priced. So hopefully you're convinced about the value of saving, and the next question is, how much should you save on a weekly or monthly basis? That depends on your income, debt level if you have debt, living expenses, and desire to save. Financial advisors recommend saving a minimum of 10% of your income as an entry-level worker in a typical job, and all the way up to 25% if you're a higher earner. The best approach is to deduct whatever percentage you decide on right after getting paid and transfer that money electronically to a savings account and forget it ever existed. When automated, this is called a forced savings plan, as it kind of forces you to save. How much should you save in total? Well, here again, your personal needs dictate the exact amount. The typical recommendation from financial advisors is to have at least 2 months of living expenses in your account, with 6 months considered more ideal. That way you have a cushion if you lose your job or some other emergency happens. You have to balance this total against the idea that if you put too much into savings, you aren't going to have cash left over to invest and gain from the benefits that actual investing would bring. The best approach is to figure out your exact monthly living expenses and just decide how many months of cushion you need to put away to sleep well at night. No more and no less. Okay, next we need to discuss the 3 savings instruments that exist, and as I get into it, a reminder to please like and subscribe so I can keep bringing you these personal finance and investing videos. The 3 primary savings instruments are the bank savings account, the money market account or MMA, and the certificate of deposit or CD. The classic bank savings account should be familiar to just about anyone who has ever dealt with a bank or credit union. You walk in, show some identification, and open a checking account with typically a savings account to go along with it. There are 2 flavors of savings accounts. The one you get as a default is the basic one, and that's what's available at a brick and mortar physical bank location. These savings accounts, especially at bigger banks, offer the lowest interest rates, however, and these rates are really not good at all. The national average as of the airing of this video in early 2024 is just 0.61% APY, with many major banks such as Bank of America and Chase offering closer to 0.01 APY,
which is more of a joke than an actual interest rate.
Fortunately, you have another option, and no one should ever really keep their money long term in these basic savings accounts. This other option is that second flavor of savings I was referring to earlier, and they're called high yield savings accounts. These pay a much higher interest rate than the basic savings, while usually still offering some regular account banking services like deposits and withdrawals. High yield savings accounts are closely related to and often get mixed up with money market accounts or MMAs. They're essentially the same thing, with some differences when it comes to offering checks and debit card services, minimum deposit requirements, and amount of monthly transactions allowed. MMAs are sometimes more restrictive with these, and as a result may offer a slightly higher interest rate in return, but in reality though, these account names are interchangeable, and I will just refer to them both as money market accounts. So with that out of the way, let's go ahead and formally introduce them and discuss them in a bit more detail. MMAs are an important category of consumer bank accounts that are similar to a regular bank or credit credit union savings but with much higher interest rates. To begin to understand them better, it helps to get a bit of insight into why exactly these accounts pay more while the regular savings accounts do not. For that, we need to look at what the bank does with the money you deposit. When you deposit cash into your neighborhood bank savings account, that money does not sit around waiting for you to withdraw it a few weeks later. It is immediately put to work earning interest for your bank as it lends that money out to other consumers. Fundamentally, this, along with those pesky bank fees, is how the bank's retail division covers costs and turns a profit. The loans made with your savings deposits are for basic consumer products such as car loans and do not generally carry a high interest rate. Therefore, the bank won't pay much interest back to you for the use of your money. With an MMA, the money you deposit is also invested, not just loaned out, and that typically earns a superior rate. The investments pursued by the bank can include various government securities like bonds, commercial paper, and other short and medium-term quality investments. That alone, however, won't net you the higher interest rate. In addition, there are often higher deposit requirements, though many banks are relaxing that to attract more customers. The higher minimums ensure that the bank has a bigger chunk of money to invest with, thereby yielding better returns. Finally, to goose the interest rates even higher, MMAs feature aggressive cost-cutting by limiting how much pricey activity is allowed on the account. With an MMA, you're typically limited in how many times you can withdraw or transfer funds or write checks against the funds. To save even more money, some banks have gone entirely online and gave up brick-and-mortar locations. Not surprisingly, these virtual-only locations offer the highest interest rates, and they're the ones I'm going to focus on the most at the end of this video. To you, the consumer, a money market account doesn't appear a whole lot different from a regular bank savings account, and you shouldn't have any reservations or qualms about opening one up. All MMAs, including online-only accounts, are protected by the FDIC up to $250,000 per account, so there's no reason to be skeptical of them. These MMA accounts are exactly where you should be keeping your savings, and they give you a fairly good interest earnings combined with 100% safety. They're easy to open up, and you can do it completely online by going to the bank's website, picking the account, entering in information about yourself, linking your checking with the MMA, and finally transferring in the funds. Be sure to look for a competitive interest rate, a low deposit minimum, and no junk fees. So, are there any downsides to MMAs? Well, the one thing these accounts are not appropriate for is long-term investing. Any money that's not considered savings should be invested, as you have the potential to earn more in the stock market. Also keep in mind, MMAs aren't good if you constantly need to deposit and withdraw money, as you're limited in the number of monthly transactions you're allowed to do, and any more than that may incur fees. Also, it takes a few days for transfers to clear, so you don't have instant access to your money. Really, MMAs are for when you're building your savings and only occasionally withdrawing from them. If you need to take out cash daily, just use your regular checking account and ATM card. Okay, we're on the home stretch here, and if you like what you're learning, please do subscribe to the channel. It won't increase your savings, but it will help me out a lot. The third and final savings instruments are certificates of deposit, or CDs. They are very common and are offered at nearly every bank and credit union. CDs are not accounts, but rather sums of money you give to the bank for a predetermined length of time in exchange for earning interest. There is a catch, however. You cannot withdraw your deposit, or in other words, cash in the CD, prior to the maturity date without incurring penalties. By tying up your money, the bank is free to invest it without the risk of having to give it back on demand. You, as a depositor, however, lose the ability to invest that money elsewhere, hence a higher interest rate is paid out to you for that opportunity loss. In other words, you're forfeiting liquidity for a higher return. The interest paid out by CDs is typically a bit higher than what money market accounts pay, and certainly much higher than regular savings accounts. Like all savings instruments, CDs are protected from loss of principal by the FDIC up to $250,000 per deposit. CDs often have a minimum cash requirement to open. This amount varies from bank to bank, though $1,000 is a typical minimum. Anything under $100,000 is called a small CD, and anything over that amount is called a jumbo CD. CDs also have varied maturity dates, or the length of time your money will be tied up. This also varies from bank to bank, but a 3-month, 6-month, 1-year, 3-year, and 5-year CDs are all common term lengths. As you may imagine, the interest rate offered varies with the term length, with the higher rates generally, though not always, offered on the longer term CDs. As mentioned earlier, CDs come with some early withdrawal penalties. You typically forfeit all or some of the interest earned prior to withdrawal, so it's important to pick a term you can live with. As such, CDs are generally far less liquid than MMAs, and definitely be prepared to not touch your money for a while. For that, of course, you get rewarded with a somewhat higher interest rate. Why even use CDs at all, you ask? Well, they're a great place to park cash for a fixed amount of time and have both FDIC protection for the the principal and a good rate of return. If liquidity is an issue, you always have the option to purchase CDs with shorter maturity dates like 3 or 6 months, but at the cost of a lower interest rate. Generally, if you need the cash in less than 3 months, an MMA is a better option. When should you not put cash into CDs? Much like with MMA, CDs are not a good idea if you're looking for growth investing for the long term. CDs will give you a modest and safe return, but they're an unlikely financial tool for retirement or for when you're seeking a significant income stream. Needless to say, you should also avoid CDs if you will need your money just a few weeks after depositing it. Opening up a CD is very easy. They are offered by nearly every bank, credit union, and even brokerages. Most people typically head to their local bank or online to purchase one, and the process isn't too different from opening a savings account. You will have to provide the same basic personal information and link a checking account to fund the CD. The bank will then request a term you're choosing and the amount you're depositing. You'll get an online account portal where you can see the deposited money, and when the term is up, you will see the appropriate interest payment added to your balance. You can then withdraw the money or roll it over into another CD, which the bank may likely encourage you to do. CDs come in a few other flavors besides the traditional ones. The two you should know about include the liquid or no penalty CD and the bump up or raise your rate CD. Liquid no penalty CDs are ones that can be redeemed before maturity with no penalty, but at a cost of a significantly lower initial interest rate. It's a good idea if you really aren't sure if you can wait out the term of the CD but still want to open one up. The bump up or raise your rate CD allows you to switch from a lower interest rate to a higher interest rate if the prevailing rates rise enough. The cost for that privilege is also a significantly lower initial interest rate to start with. It's a bad gamble if you think that rates will rise, but they don't, and a good gamble, of course, if the opposite happens. The last item that needs mentioning when it comes to CDs is the CD ladder. This is simply a technique where you purchase numerous CDs at predetermined intervals but of similar maturity dates. They then mature at regular intervals, giving you more liquidity to access cash or the ability to reinvest it at a higher interest rate in a rising rate environment. They resemble steps in a ladder, hence the name. You never have the full amount tied up in one lump sum, and the staggered maturity dates gives you a lot of flexibility in how you use the money and plenty of chances to reinvest it in something else while still getting the benefits and protection of a CD in the first place. Okay, and now, as promised, let's list out the top money market and CD rates that are available right now and mention the banks that are offering these. This information is current as of January 2024, but of course rates change all the time, so check with the banks that are listed here for the latest rate info. Now, almost all major banks like Chase, Bank of America, Citibank, Wells Fargo, and others have MMAs and CD options. However, they rarely have the best rates. Instead of mentioning them, I highly recommend checking out the lesser known and mostly online banks. They're just as safe as the big ones, as they must all carry FDIC protection and the rates they offer really can't be beat. Now, of course, I'm not endorsing any of these, although I do use several of them myself, but rather I'm just letting you know what is out there. The first one is Ally Bank. This online-only bank, which you can find at ally.com, has a money market account that pays 4.4% APY right now and a traditional high-yield CD that goes as high as 5.15% APY when you select 18 months. Ally charges very few fees and it's one of the bigger and more popular names in online banking. The second one is CFG Bank. This is a mostly online bank with just 3 physical branches and it can be found at cfg.com. Their money market account pays 5.25% APY right now and a traditional CD that it comes in at 5.35% APY when you select 12 months. The third one is CIT Bank. This online-only bank, which you can find at cit.com, has a platinum savings account that pays 5.05% APY, though there is a requirement to maintain more than $5,000 in the account to receive that rate. They also have 13-month and 18-month CDs that both pay 4.65% APY with a $1,000 minimum. The fourth one is Discover Bank. Found at discover.com, this online-only bank has a high-yield savings account that pays a 4.35% APY and a CD that tops out at an impressive 5.30% APY for a 9-month term, though a $2,500 minimum applies. The fifth one is Everbank. Found at everbank.com. Everbank has a high-yield savings account that pays 5.15% APY and a CD that pays out an excellent 5.50% APY for a 9-month term, but there is a $1,000 minimum. Number 6 on the list is the mostly digital Quantic Bank, found at quantic.com. They offer an MMA paying 5% APY and a 1-year CD coming in at 5.30% APY. At number 7, we have Sallie Mae, found at salliemae.com. I personally use this online bank and have an MMA with them that currently pays me 4.75% APY. It's not the highest rate out there, but I do like the customer interface and lack of junk fees, and I've stuck with them for a few years now. If you want to open a CD, their best rate is currently 5.55% APY, which is actually one of the highest I've seen, and that is for a 15-month CD with a $2,500 minimum balance accounts requirement. Number 8 is UFB Direct, an online-only bank found on UFBdirect.com, and it features both high-yield savings and an MMA with 5.25% APY for both. Interestingly, they're one of the few banks that do not offer CDs. Finally, to finish off, we have VioBank at number 9. Found at VioBank.com, it's another online-only bank that I have an account with. Their rates are quite good with the MMA offering 5.30% APY and a 6-month CD coming in at 5.35% APY. I personally found their interface a bit clunky and amateurish, but on the positive side, their customer service was always very responsive. These, of course, are just a sample, and there are many more online banks out there. It really pays to shop around and compare rates, fees, and account minimums. Okay, that was a complete survey of savings, and I hope you really enjoyed this tutorial and got a lot out of it. Please do consider subscribing if you haven't yet, and I will see you in the next video.